If your spouse died this month, what would happen to the household income next month? Most couples can't answer that number. Not because they don't care, because nobody made them sit down and run it. The widow's gap is the quietest financial risk in retirement. Sequence of returns risk gets podcast. Long-term care gets headlines. The income one spouse loses when the other dies gets neither, and it happens almost every time. I'm Micah Brown. I'm insurance licensed in Michigan. Today I'm going to walk through exactly what changes when one spouse dies, the 4 buckets you can pull from to close the gap, and the pension election form most couples sign without understanding. So what actually changes? When one spouse dies, 3 things shift inside 1 month. Number 1, Social Security goes from 2 checks to 1. The survivor does keep the higher of the 2 checks, the other one stops. Number 2, pension income may stop or be cut depending on what you elected. And 3, the tax brackets narrow. Married filing jointly becomes single. Same income, higher tax. What doesn't change is your mortgage if you still have one, any property taxes, utilities, food, car insurance, and the Medicare premiums. Actually, those can go up. Your income drops, most of your expenses don't. The gap is the difference, and it's almost always bigger than couples realize. Social Security. So, when one spouse dies, the surviving spouse keeps the higher of the 2 Social Security checks. The other check stops. If one spouse was receiving $2,800 a month and the other was receiving $1,800, the household loses $1,800 every month. Annualized, that's about $21,000 a year gone. This isn't a temporary loss, it's the rest of the surviving spouse's life. And the loss is sometimes bigger if the surviving spouse hadn't started Social Security yet, or if there are early claiming reductions on the higher check. Survivor benefit rules are a category of their own, and they're worth understanding before either spouse files. So, 2 checks become 1. You need to plan accordingly. Pensions. If you or your spouse have a pension, what happens at the first death depends on the election you made when the pension started. If you filed for a single life pension, the check stops at the pensioner's death. You do get a higher monthly payment while alive, but there's nothing for the survivor. A 50% joint and survivor. The surviving spouse keeps 50% of the original payment. 75% joint and survivor, the surviving spouse keeps 75%. And 100% joint and survivor, the survivor keeps the full original payment. The higher the survivor percentage, however, the smaller the original payments when the pension was elected, because the pension fund is calculating the longer expected payout. If you sign for single life, even by mistake or in a moment without thinking, the decision is usually irrevocable. The check stops at the first death. There's no fixing it after. If you're about to retire and you have a pension election form in front of you, this is the part of the plan that deserves real time. Next, we're going to talk about the widow's tax bracket compression. We've covered this in earlier videos, but it belongs here too. If you're married filing jointly, you have a wider tax brackets than single. The survivor goes from joint to single for life in most cases. Same income, smaller brackets, higher effective tax rate. 20 or 30% more goes to the IRS of the same dollars. This compounds the income loss. You're not just losing the second Social Security check. The remaining check is being taxed at a higher rate. Your pension income is taxed at a higher rate. RMDs from retirement accounts are taxed at a higher rate. The widow's gap is income loss plus tax compression. Adding both is what makes the number real. So where are the 4 buckets you can pull from to offset this? There are 4 places that you can go to close this gap. Some couples use one, some use a mix. You have life insurance, your pension election, a survivor-focused annuity income, and portfolio rebalancing. None of these are universal. Each one fits a different situation. Most plans I see lean too heavily on one and ignore the rest. Life insurance is up first. So most people on the high earning spouse will get a life insurance policy, which gives the surviving spouse a tax-free lump sum to bridge the income loss. For a couple where the higher earner has a pension and is 60, this might mean a term policy that runs into the surviving spouse's late 70s, covering the early widowhood years when an income loss is sharpest and when the surviving spouse may not have started Social Security yet. For a couple where the legacy goal matters, a permanent life insurance policy can do both jobs: close the widow's gap and pass an inheritance. The size of the policy comes from the math. Annual income loss times the years that loss matters, adjusted for taxes and inflation. Not a guess, a calculation. The second bucket is your pension election. Choosing a higher surviving percentage on the pension election reduces both the income while both spouses are alive, but protects it for the survivor. The trade-off is real. 100% joint and survivor might pay a couple $100 a month less than the single way. Over 20 years, it's a real number. But the pension election is permanent. Once you sign, the door closes. For couples without other ways to protect the survivor, the joint and survivor option is often the better trade. The third bucket, an annuity. Income annuities can be structured with joint life payouts, similar to a pension and survivor options. Money goes in, a promise goes out. As long as either spouse is alive, the income continues. For couples without pensions, an income annuity layer can synthesize the same kind of survivor protection. This isn't the main job of every annuity, but where it fits, it's clean. And fourth is portfolio rebalancing. If the portfolio is a main income source, the question is whether the safe withdrawal rate still works after one spouse dies. Usually the answer is yes for couples with an adequate portfolio size. The expenses don't drop in half, closer to 2/3, but the income from the portfolio also has to fund only one life expectancy now. The math works for many couples. It doesn't work for couples with smaller portfolios or higher fixed expenses. That's when buckets 1 through 3 come back into the conversation. So, what do I do for my clients over 55? If you're over 55 and married, here's a model I'd want run. Scenario 1, your current setup. Calculate your household income, expenses, and net cash flow today. Scenario 2, the higher earner dies in 5 years. Show the income drop, tax change, portfolio impact year by year for 20 years. Scenario 3, the lower earner dies in 5 years. Same exercise. If either scenario shows a survivor running out of money in their late 70s or 80s, the plan isn't complete. The buckets exist to fix that. The question is which mix. Most couples never see scenarios 2 or 3 on paper. The plan they have was built for 2 of them, not 1. So, what happens when 2 checks becomes 1, but your bills stay the same, your tax bracket narrows, the gap is real, and it's almost always getting bigger than couples imagine until they run the math? I built a free widow's income gap worksheet that walks through the income loss calculation, the pension election trade-offs, and the 4 buckets you can use to close the gap. DM me the word widow on Instagram or comment here and I'll send it over. Next in the series, we're going to talk about Medicare Supplement versus Medicare Advantage. The real trade-off, not the brochure. See you there.